Okay, we have about 20 people here. We should get started, and hopefully anybody joining a little late can catch up. We're doing the second half of chapter 8, and then we're going to look at chapter 16. The second half of chapter 8 covers what's called demand loans. So let's bring one of these questions over to the whiteboard and discuss demand loans. So when we're dealing with demand loans, what a demand loan is a situation where some individual has borrowed money from a bank. And there can be two situations here. Either the individual has a bank account at that bank, or the individual does not have a bank account at that bank. I don't know why the bank loaned the money if they don't have a bank account there, but apparently that's possible. And if the individual has a bank account at the bank, so that's the separate interest method. So the individual has a bank account at the bank. And what this means is when they're paying back the loan, they can do two separate calculations. They can have one calculation just for the principal of the loan, and they can have one calculation just for the interest. So and so when we're dealing with this separate interest method, and we'll take a look at an example, because they can separate the two calculations, it makes the process quite easy. But let's take a look at what they call the declining balance method. In this case, the borrower does not have a bank account at the bank. And as they don't have a bank account at the bank, the process when they're paying it back becomes fairly complicated, because when the borrower comes in to make a payment on the loan, the first thing the bank teller has to do is figure out how much interest has accrued on the loan. And then the bank teller takes the person's payment, deducts the amount of interest, and can apply the rest of it to the principal. So let me see if I can put that in words. So that's basically how the two processes work. So when you're being given a question, you have to know, you have to be able to determine. In this question, they were very clear. They said, use the declining balance method. So we will use the declining balance method, but you have to be very clear about which method you're using, because it will make a difference in the calculation. So having said that, let's go ahead now and calculate this. Let's copy this and put it on, oops. Let's try that again. Let's see if we can copy this and put it on the next page, seeing as I've wasted half of this page with explanation. So here we have the question. On April 2nd, Kelly borrowed $15,000 on a demand note with an interest rate of 9% per annum. Payments were made of $2,800 on May 14th and $2,400 on June 19th. And how much was the final payment made on August 3rd? So we can sort of imagine what happened. On April 2nd, Kelly goes into the bank. I'm not sure if Kelly is a man or a woman, and apparently it doesn't really matter. So April 2nd, we know Kelly borrowed this money. So Kelly borrows $15,000, and the rate that they borrowed it at is 9%. So payments were made on May 14th. So Kelly doesn't come back into the bank until May 14th. So Kelly shows up with $2,800. And the bank teller has to figure out how many days between April 2nd and May 14th. So I'm going to find my chat box here. And I'm sure someone will tell us those days. They didn't tell us a year, and it doesn't really matter because we're not going over February or the end of February. So we're not worried about leap year. So how many days from April 2nd to May 14th? Let's go with 42, unless someone says that's a terrible answer. So what the bank teller has to do is take the $15,000, and the equation we're using here is simply interest equals principal times the rate times the time. So the principal times the rate, 9%, times the time of 42 over 365. So how much interest has accrued on that loan? And I'm hoping somebody will figure that out for us. So 155.34. Thank you. 155.34. So $155 is now interest owing, referred to interest that has accrued on the loan. So the teller finds out how much money Kelly is wanting to pay today, and it turns out to be $2,800. $2,800, but the first thing the bank does is take its $155.34. So how much is left of the payment after the bank has taken its pound of flesh here? Uh, 2644.66. So this is the amount of the payment that can be applied to the principal. In other words, this is how much they're going to actually pay back. The 155, they just had to pay that to the bank for interest. So take the outstanding principal, 15,000, minus the 2,644 minus 60 or 0.66. And how much is the outstanding balance of the loan now? One, two, three, 5.34. So at this point, the whole process starts over again. Kelly doesn't show up until June 19th. So Kelly walks into the bank on June 19th, says, I'd like to make a payment. The first thing the teller has to do is figure out how many days have transpired since the last payment. And we're getting 36 days here. So the next thing the teller has to do is take the outstanding principal, which is now down to 12355.34, multiplied by the 9% and multiplied by 36 out of 365 to figure out how much interest has accrued on the loan. And we're getting 109.67. I can live with that as long as nobody freaks out. So the next thing the teller has to do is figure out how much money Kelly had with him or her today. And it turns out to be 2,400, but they've got to pay the bank the 109.67 interest. So how much is left of the payment to be deducted from the balance? I'm seeing the balance. I think that's the answer we want down here. Oh, that's a weird number. That's a really weird number. Let's get rid of that. 2290, 2290.33. So this is how much money can be deducted from the, or applied to the principal. So find the principal again. 12355.34 minus 2290.33, and we'll again find the balance of the loan. So 10065.01. And now the whole process starts over. And at this point, we're glad that it's only 3 payments. So Kelly shows up again on August 3rd. And says they want to make a payment. So how many days have transpired from from June 19th to August 3rd? We'll go with 45. So the next thing the teller has to do is take the outstanding balance multiply it by the rate of interest, 9%, and 45 over 365. So how much interest has accrued on this loan in those 45 days? $111.68. And at this point, Kelly says they would like to pay off the entire amount. So the bank teller is going to take the outstanding balance plus the accrued interest and add them together and tell Kelly how much this final payment has to be. Kelly better have a fair chunk of money with him or her today. So that is an example of how the declining balance method works. We always have to figure out the accrued interest, deduct it from the payment, and then apply the payment to the loan. If this gets any more complicated, as in more payments, it would be worth setting up an Excel spreadsheet. But most of these questions they give you are fairly simple, and they only have about 3 payments. So it's fairly straightforward to calculate that. So any questions on how the declining balance method worked before we take a look at the simple interest method? Or the separate interest method. Okay, let's save that.
Excuse me, sir.
That. And clear that. And take a look at the separate interest method. So someone by the name of Jamie borrowed $900 from the Essex District Credit Union. The loan agreement provided for repayment of the loan in 4 equal monthly payments plus interest at 12% per annum, calculated on the unpaid balance. The credit union will withdraw the interest payment from Jamie's account. And so Jamie obviously has an account at this bank, and we can use the separate interest method. What was the loan balance outstanding after the second payment? And how much total interest did Jamie pay on the loan? So let's take a look at the calculations we have to do here. We know that Jamie borrowed $900. We also know that, again, he or she, we're not quite sure, is making 4 equal monthly payments. So divided by 4 equals, what is 900 divided by 4? $225 sounds good. So they're going to make payments of $225 every month. And every month, the bank is going to collect interest of 12% calculated on the unpaid balance. Now, they don't give us any actual dates, so we'll just go with payment number 1, or we'll go 0, 1, 2, 3, and 4. So in time period 0 here, we've got $900, and it's going to accrue interest in this between here and here. So 900 times 12% times, and we can only go for 1/12 of a year. So how much interest has $9? So the bank takes $9 out of Jamie's bank account. And now the next calculation they have to do is 900 minus 225, because Jamie made a payment of 225. But we can do it separately, 675. So for the next month, Jamie owes $675, still at 12% for 1/12 of a year. So how much interest does the bank steal out of Jamie's bank account? Really? 675? They're just trying to be confusing here. How annoying is that? So they steal 675 out of the bank account, and Jamie makes a payment. So we can take the 675 minus the 225, and how much is left owing? $450. So for the next month, there's $450 outstanding at 12% for 1/12 of a year. And how much interest has accrued? And I'm betting it's $450. So they make a payment. So there was $450 outstanding. They paid $225, and now we should be down to $225. So for the last month, there's $225 outstanding at 12% for 1/12 of a year. And I'm betting that comes to $2.25. And then they make a payment of $225, and the balance is down to $0. So they've said, what was the loan balance outstanding after the second payment? So this was the first payment, the second payment. It had to be the $450. So this had to be $450. And how much total interest did Jamie pay on the loan? We don't know that yet, but we have to add up this column of numbers. Comes to $2250, does it? That's good. And so that's why they call it the separate interest method, because we can totally separate the interest payments and the principal payments. And because we can separate them like that, it makes the whole process fairly easy. You just have to remember which method you're using. And the questions are usually pretty clear about which method you're using. But if the person does have a bank account at that, if they mention someone's bank account, then you're automatically going to use the separate interest method. So any questions that you can think of asking about how that works? Okay, let's take a look at the next question we want to try here. Let's save this. So on March 15th, Julio borrowed $900 from Sheridan Credit Union at 7.5% per annum, calculated on the daily balance. He gave the credit union 6 checks of $135, dated the 15th of each of the next 6 months, starting April 15th, and a check dated October 15th for the remaining balance to cover payment of interest and repayment of principal. They want us to use the declining balance method, and they've given us the format to use in figure 8.7 and shown us how to use it in figure 8.9. And so I have put this on an Excel spreadsheet. So let's go over and find that spreadsheet, and I'll explain how that spreadsheet works. Let's get rid of that for a moment. Okay, I will try to share my Excel spreadsheet with you. Let's expand this a little so you can actually read it. Get rid of all these smiling faces. So is this, is my spreadsheet visible? Can anybody see the spreadsheet? Or more importantly, can anybody not see the spreadsheet?
I don't see it, Mr. Brown. It's just a list of.
No, you can't see the spreadsheet?
No.
Wonder why not?
We can see it now.
So can anyone see the spreadsheet? No. Okay, that's weird. Wonder
It's
why.
showing already, Mr. Brown.
Yes.
Yes.
Yes, we can see it.
Okay. Can anybody not see it? So we're good. So let's take a look at the spreadsheet then. So this is the same question I just read out. And the format they've given you here is they want you to make a column for the payment number, which is straightforward enough, because we know they created 6 checks and then an extra one for the balance. So we're going to keep track of the balance before the payment, the amount they've paid. This is the payment, the 135. We have to calculate the interest, and that's how the declining balance method works. We calculate the interest, and then the principal repaid. This was the calculation we were doing where we subtracted the interest from the amount they paid. So in this case, they're paying $135, but the accrued interest for the first period is $573. So once we take off the interest, the principal repaid, the amount of the payment that can be applied to the principal, is down to $129. And then we start with the outstanding balance. We take away the principal repaid in this cell. And so we get 900 minus 129 equals the 770. I created a couple other columns here. For one thing, it's easier to keep track of the interest rate in a separate column. And the dates, and notice when you're using Excel, there's a command here called edate, and you probably can't read it, but I'll type it up here. Equals edate, and whatever date you're dealing with could come from here, and then a comma, and I put in a 1. And notice what this does for me. I start with a date of March 15th, and I go edate the March 15, and then comma 1, and Excel will automatically figure out that this is 1 month. This edate function will allow you to add a 1 month each time. And then over here for the days column, I just did this minus this, and it automatically gives me the number of days, because annoyingly enough, some months are 30 days and some months are 31. But because this was calculated on a daily basis, we needed to know the exact number of days. Because when we're calculating the interest, what I've got to do is I had to take the payment times the interest times the number of days divided by 365. The same calculation we had to do when we did the other declining balance method calculation, but now I've programmed it into Excel. And I can send you this Excel spreadsheet. I don't think I've sent it to you already, but I will send it to you so you can sort of examine the details of how this worked. But once we've figured all that out, once we basically figure out the first row of what has to happen, then we could just calculate it down. The last row, we had to do some work on. So here we got to the last row, and if they paid 135, there would have been an overpayment here. So this last payment had to be the sum of the balance before payment plus the interest to make this payment exactly enough. So the balance after the last payment is exactly zero. So like I said, if you're dealing with the declining balance method and you've only got 2 or 3 payments, it's fairly straightforward just to do the calculations by hand like we did. If you start getting, like here we had 7 payments and it could be many more than 7, then it's really worth setting up the spreadsheet where once you've created that first row, you just copy it down and it'll do all these calculations for you. So what did they, I don't know exactly what they asked us for here. I think they wanted to know what the last payment was. And it turned out that the last check had to be for $112.36. So that's a situation where you're dealing with enough payments to make it worthwhile to set up that Excel spreadsheet. And I'll send you that spreadsheet. So that's all I'm going to sort of inflict on you about the last part of chapter 8. The last part of chapter 8 only deals with understanding how to use the declining balance method and how to use the simple interest method. So now what we're going to do is take a look at chapter 16. Oh, someone asked, could you explain the last payment? Yes, let's go back to that spreadsheet and see if we can explain that. So can you see the spreadsheet again?
Yes.
Okay, so we were told that he gave the credit union 6 checks for $135 and a check dated October 15th for the remaining balance. It should say to cover payment of interest and repayment of principal. Let's change that. To cover. So what we knew, let's get rid of this here. If we just copied this down, then what we would find out is if he made another payment of $135, he'd have overpaid by $22.64. So we want this to equal 0. And the way we're going to make this equal 0 is we're going to look at this payment here, because this payment is where he's paying too much money. And what we want this payment to cover is we want it to cover the outstanding balance, which came from here, right? We just transferred this over from here, and the amount of interest that has accrued. So we know that we want it to cover the outstanding balance plus the interest, but no more. So this column here, instead of making it equal to this, we're going to make it equal to this plus this. And when we do that, suddenly we see that the principal being repaid is this amount, and the bank takes its 69 cents interest, and the balance now comes down to zero. So, Sukhbir, does that help you understand how you're going to find that last payment?
Yes, sir.
Yeah. Once you've set up the first row, you just copy it down. But when you copy it down, you'll always have a final balance which doesn't quite equal zero. So you'll always need to adjust this last payment to make this number zero. I'll save that. And I'll send that spreadsheet to you, and hopefully you'll be able to make sense out of it. So let's go over and look at the Excel files for chapter 16. So what we're dealing with in this chapter, to start with, is something called net present value. And what they mean by net present value is when we evaluate how much a project is going to cost, it has to be evaluated in terms of today. So you're basically making guesses based on how much you think it's going to cost at various points in time, and how much the interest rate is, and how much, and in some cases, how much revenue it's going to generate. But they all have to be evaluated in terms of today. So if you are calculating this by hand, which I'm not going to do because there's no point in doing it by hand, but if you're doing it by hand, you'd be taking all of these sums and finding the present value, and then you'd be evaluating it in terms of today. So, but Excel will do this for you, and the BA2 Plus will do it for you if you know how to set it up. So let's look at the scenario we're being presented with here. A warehouse can be purchased for $90,000. After 20 years, the property will have a residual value of $30,000. Alternatively, the warehouse can be leased for 20 years at an annual rent of $10,000 payable in advance. If
And
money
Mr.
is,
Brown, sorry to interrupt. Are you sharing your screen? Because I cannot see anything.
oh, I'm very sorry about that. Let's find out why you're not seeing my screen. Let's get rid of that.
I can see now. Thank you.
So you can now see my screen?
Yes.
Okay, I'm sorry, I didn't realize you couldn't see the screen. Yeah. So let's look at the scenario we're looking at. A warehouse can be purchased for $900 or $90,000. After 20 years, the property will have a residual value of $30,000. Alternatively, the warehouse can be leased for 20 years at an annual rent of $10,000 payable in advance. If money is worth 7%, should the warehouse be purchased or leased? So we have some important numbers. The 90,000 is the purchase price. The 30,000 is the residual value, sometimes called the salvage value. And 20 years is the years of useful life of the building. That's if we buy it. If we lease the building, $10,000 is the annual cost of the lease, and 20 is the life of the lease. So the 7 is the interest rate. It doesn't matter whether we're buying or leasing, the interest rate is still 7%. So we know this is an ordinary annuity because the interest rate is annual and the rent is annual. We also know this would be an annuity due because the rent payments would be at the beginning of the period. But that doesn't really have a lot of effect on us here in this calculation. So let's take a look. We're going to set up what I refer to as the net present value schedule in Excel. So first off, let's look at the concept of buying the warehouse. In the first box here, we're going to put the 7%, comes out to be 0.07. And then we put the initial investment, the 90,000. And then we've got to list all 20 years. Turns out for the first 19 years, there's nothing happens because we own the warehouse. But the net cash flow at the end of period 20 is 30,000. Because that's the residual value, presumably we sell it. And then in this cell here, I've typed over here what we're actually doing. The command is, sensibly enough, NPV for net present value. And then the first item here is the interest rate. And then we have a column of values, but notice this does not include the initial investment. So this just gives us the net present value of the 30,000 at 7%. So it turns out that the present value of 30,000 turns out to be about 7,752. In this chapter, they tell us that these are only estimates, and so we're always rounding these things to the nearest dollar. It should make it a little easier, but that's what we've done. We've rounded it to 753 or 7,753. And then we've taken the 90,000, which we had to pay today, minus the amount we're getting back in terms of today. And we find out the entire cost of leasing the warehouse, or no, buying the warehouse is about $82,247. So that's the situation we have. If we buy the warehouse, it'll cost us about 82,000. So we can't make a decision until we do the same thing for leasing the warehouse. Again, we have the interest rate, the 7%. Now notice the initial investment, because we have to make the payment at the beginning of the period, the first 10,000 we pay today. So that's considered the initial investment. And then we have all the other 10,000s, although they say at the end of period 1, we know it's at the beginning of the second period, right? Because the end of the first period is always the beginning of the second period. But this net present value function in Excel always deals with cash flows at the end of the period. So we've got to say the cash flow at the end of period 1, which is really the beginning of period 2, is a negative 10,000. So we do this for 19 years. This one at the end of period 19 is really the beginning of period 20. And we find the net present value of that. We still have to account for the fact that the initial investment was 10,000. And so we end up finding out that if we lease the warehouse in present day terms, it would be costing us $113,356. So our conclusion would be that buying the warehouse would be a better option. It would cost us less. Now we can do this on the BA2 Plus. We can take a look at it here, and then we can actually try it on the BA2 Plus. But if you take a look at your calculator, beside the second button, there's a little button that says CF. And that is cash flow. That CF must stand for cash flow. And so we have to enter these cash flows that we've created here. So the first thing you want to do is go CF, second, and then clear. And this will clear the registers. You want to get used to doing this before you ever use the cash flow. Clear the registers of any other numbers. So now that we've cleared the registers, I'm going to go CF. And when I do that, I can see on the screen CF and a little O or a little 0. And so this is going to be 90,000. It's got to be negative because that's how much we're paying to buy this warehouse. Go enter and down. So 90,000. And try it on your calculator. Plus, minus. Enter, down. And now we're looking at C, which is cash 1. And we're not paying anything because we own the warehouse. So we put 0, enter, down. And this F here stands for frequency. How many times do we have to do this? Now notice when we're doing this on Excel, we had to separately list every year. On your calculator, thank God, you don't have to do this because we knew that this was 19. So cash flow, the frequency is 19. Put 19, enter, and down. So the next cash flow we're worried about is the salvage value, the residual value is 30,000. And this is a positive amount. So we don't hit plus minus, just hit enter and down. And over here for the frequency, how often does this happen? Once. So 1, enter, down. Now we're looking at cash third, but there's no third cash flow to worry about. So hit NPV, which is the next button over from CF. And at this point, it says I, meaning what's the interest rate? So we can just put in 7. It doesn't have to be 7% or 0.07, just 7. And then again, enter and down. And now we're looking at NPV, but it doesn't know what to do yet. Go compute. And you should be looking at negative 82247.42992, which we're going to round to the closest number, 82247. Now, would you like to see me do that on the BA2 Plus on the screen? NPV full form. What is full form? Full form.
Hi, Mr. Brown. Could you kindly show it as when I arrive at CO3, I don't see NPV.
Oh, no, you don't see it on your calculator. You just have to hit the button, the NPV button.
All right, I'll try it once again. Thank you.
NPV means net present value. Um, So the reason we're rounding to whole numbers is explained in the textbook. They just say that these are only estimates. And so we don't really need to worry about the pennies. So this was using the BA2 Plus for the calculation for buying the warehouse. Let's take a look at the same calculation for leasing the warehouse. And the first thing you want to do is go CF second and hit clear a couple times to clear all those registers. And then we'll go CF. So we're now looking at CFO equals. And so the initial investment here has to be the 10,000, and it's got to be negative plus minus, and enter and down. And then we're looking at cash flow 1, is again 10,000. And I don't have it as negative here, so let's hope that works. Let's go enter and down. And again, the frequency, F is the frequency. This has to happen 19 times. So 19, enter down. And then we have cash flow 2 here, but there's no residual value. So we're not worried about cash flow 2. So here we have to hit the NPV button, and it asks us the interest rate again, 7, enter down. And now we're looking at NPV. The calculator doesn't know what to do yet, so go compute. And I got 93355, which is not the answer I wanted. And what I'm thinking is that this 10,000 had to be negative. So let's find out if that is indeed the case. Let's go back and try it again. I'll clear everything. CF 10,000 negative, enter down. Cash flow 1, 10,000 negative, enter down. 19, enter down. Then NPV 7% or just 7, enter down and compute. And now I get the answer that I claimed to get the first time. So I will have to fix this spreadsheet, and I'll have to resend this to you. This has to be, there has to be a plus minus in here. So I will fix that and send it to you. Now we're looking at this number compared to this number, and we can again see that buying the warehouse is the best option. So did that work on your calculator? Because if it didn't work after we fixed it, okay, let's take a look at the next question, see what else they can do to us in this chapter. So to start with, can people see this question?
Yes.
Okay, that's good. So your old car cost you $600 per month in gas and repairs. If you replace it, you could sell the old car immediately for $4,000. To buy a new car that would last 5 years, you need to pay out $20,000 immediately. Gas and repairs would only cost you $240 per month on the new car. Interest is 9% compounded monthly should you buy a new car. And I've added a hint here that says gas and repairs happen at the beginning of each month. It does make sense that you have to put gas in your car at the beginning of each month. So that's the way they did the situation. So we need to sort out the important numbers required for buying the car. The car costs $20,000, but you can sell your old car for $4,000. So the cost of your car minus the trade-in is 16,000. But as you've got to pay gas and repairs at the beginning of the month, your initial expense for the first month would be 16,240. Excuse me. And after that, you're going to be paying $240 per month for gas and repairs. And you've got an annual interest rate of 9%, but I've divided that 9% by 12 because we've got to figure out the interest rate per month here. So having sorted out those important numbers, then we can look at the net present value spreadsheet. The first thing that goes in here is the interest rate, but it's the interest rate per compounding period. So it's the 9% divided by 12. The next thing is the initial investment. In other words, we buy the car, we sell our other car, we pay $240. I'm a little worried that we had to repair the car, but at least we had to put gas in it at the beginning of the month. So that $240 has to be in here. So our initial investment is the $16,240. And then we have these cash flows. And again, we have this strange situation of the way this spreadsheet works. The cash flows says at the end of period 1, but we really know it's at the beginning of period 2. And so there's all these 240s. And for the Excel spreadsheet, we have to list them all the way down for the 5 years. So then we have the net present value, and this just includes the 240 we're paying out every month. And then we need to include the initial investment. So it turns out that over the 5 years, the total cost of the new car is $27,648. So we try the same thing with the old car. The initial expense has to be the 600. And then for every month after that, you're still paying 600 for gas and repairs. The interest rate is still 9%, but we've still got to consider it monthly. So the monthly interest rate goes in here, the initial investment here, and all these 600s for the life of the car, or for the 5 years anyway. Car hasn't died yet. So once we add the 600, the present value of all these 600s together, and include the 600 at the very beginning, we find that the cost of keeping the old car is $29,121. So we compare the two. Over 5 years, the cost of buying the new car, $27,000. Over 5 years, the cost of keeping the old car, $29,000. We should buy the new car, it would be less expensive. And then we try doing the same thing on the BA2 Plus. Remember, clear those registers first. Let's try it. CF, second, clear. So, considering the numbers we've figured out, we go CF, and we're looking at CF0. We know this was 16240. And weirdly enough, I've entered them both as positive, and we're ending up, I think we'll end up with a positive number for the cost. We could have entered them both as negative, but let's continue with the positive and go enter down. And then we're looking at cash flow 1, 240. I still left it as positive, enter down. And how many times does this have to happen? 59 times. So 59, enter down. And then we're looking at CO2, which is the second cash flow, but there is no second cash flow. So we hit the NPV button. Now it needs to know the interest, and our interest was, I've put 0.75 there, which is the annual interest rate. So that's good. 0.75, enter down. And it tells us NPV is 0, but we go compute. And we come up with 27,648. You could try making both of the numbers negative, and I think you'd have a negative sign there, which would make more sense as it's a cost. But for some reason, I skipped the negative signs and just left it all positive. So that's the buying the car. Let's do the same calculation for keeping the old car. But clear the registers first. CF, second, clear. So CF, and our first expense is 600, but I've left it as positive. Enter down. And then we're still paying 600 every month. So enter down. And we're doing this 59 times. 59, enter down. And there's no cash flow to, so hit NPV. And 0.75 for the interest. Enter down and compute. And we get 29,120.8. So I've rounded that. That's weird. What number are you getting? I'm getting 29,120.8. Yeah, I am too.
Also for me, Mr. Brown, the same.
Yeah, so I think I just typed this in wrong. Let's change it and pretend we never saw that. So 29121, what did we get when we used Excel? 29121, yeah. So obviously I just typed that in wrong. So another reason I have to send you this spreadsheet. So the nice thing about the Excel or about the BA2 Plus is you don't need to list every period separately. So any questions on how that worked before we try another one? See what else they can do to ruin our day here. So I'm hoping you can see the spreadsheet. If I start reading a question that you can't see, let me know. A company is considering a project that will require a cost outlay of $15,000 per year for 4 years. At the end of the project, the salvage value will be $10,000. The project will yield returns of $60,000 in year 4 and $20,000 in year 5. There are no returns after year 5. Alternative investments are available that will yield a return of 16% should the company undertake the project. So notice they've complicated this slightly because in the first 2 questions we did, we were only paying. We either paid for the warehouse or paid for the car. Now we have money going out and money going in or coming in. So I've sorted out the important numbers we're going to need. The 15,000 is the cost outlay per year for 4 years. The 10,000 is the salvage value. We get $60,000 in year 4 and $20,000 in year 5. And the interest rate is 16% that we're going to compare this with. So notice what I've done to the Excel spreadsheet here. I've got a column of outlays, which is money we're spending, and a column of inflows, which is money that's coming in. And over here, this is our actual NPV spreadsheet where I'm adding these two. So here, this one is the inflow minus the outlay. So in here, we end up with a negative 15,000. For the next year, also negative 15,000, then a negative 15,000. And now we get a positive 60,000 and a positive 30,000. The salvage value adds to the last inflow. So here, what we did was we added the 20,000 that they got in the last year, plus the salvage value. So this last inflow has to include that salvage value. So now we have this column of numbers that we're dealing with. And when we calculate the net present value, which doesn't include the initial investment, and then the net present value, including that initial investment. I'm not sure if I like this number at all. Let me think about that. That's the net present value of that, and that. And then we took away that 15,000. So that, as far as I can tell, that number seems to work. The net present value of the investment is negative 1,267. And if the company requires a rate of return of at least 16%, the net present value of this project is negative. So the company should not, they shouldn't do this project. They should reject it. So let's try the same thing on the BA2 plus. But the BA2 plus doesn't allow us to separate out inflows and outflows. The BA2 plus only wants the numbers in this last column. So let's try it. First off, let's get rid of everything in the registers. CF, second, clear. So hit CF. For the first thing we have to do is pay 15,000. So it's negative, which makes sense. Enter down. And now for the next cash flow, there's 15,000. It's negative, which makes sense. And this had to happen for 3 times. We can see up here on our spreadsheet, the 3 15,000s, but we combine them all in here. When we go enter down, the frequency is 3, enter down. Now the next cash flow is the 60,000, 60,000, and this is positive, makes sense. Enter down, and the frequency of this is 1 because it only happens 1 time. So 1, enter down. The next cash flow is the 30,000. That's the 20,000 plus the 10,000 residual value. So 30,000, it's positive, enter down. And then the frequency of this one is 1. So 1, enter down. And now it wants to know about the 4th cash flow, but there is no 4th cash flow. So hit NPV. Now it wants to know the interest rate. It's 16, enter down. And now we have to compute the net present value, compute, and we get negative 1267.48677, which we round to 1267, which is basically what we got up here. In fact, exactly. So that's a situation where we have inflows and outlays. And I find it much easier to set it up in Excel where you can keep track of the money that you're paying, the money that you're getting, and then the result here. When you do it on the BA2 Plus, you're only dealing with the last column. So it makes it much easier if you've looked at it in Excel. And then you try it on the BA2 Plus. But it's not impossible to calculate these by hand quite easily without doing them in Excel. So any questions you can think of asking at that point? This this is all we're, oh no, I was going to say this is all we're doing in chapter 16, but I'd be lying. We do also something called internal rate of return. So let's look at the next question. Indeed, now we look at something called internal rate of return. With the net present value, what we were doing was we were supposing that we knew the rate of return that we wanted to get. When we're calculating the internal rate of return, what we're going to be calculating is the rate of return that we will be getting. So this is, I know we've gone through about 16 chapters of this textbook, and this is the end of the last chapter. But for you people who are studying project management, this is really all you needed to know from this whole textbook, this internal rate of return. This whole textbook has been leading you up to this point here. This is what you need to know. You need to understand internal rate of return. So now that we've finally got here, let's make sure we know how to calculate it. So your firm is introducing a new product for which net returns are expected to be. So for years 1, 2, and 3, we're going to be making 20 grand a year. For years 4, 5, 6, 7, and 8, we're going to be making 50,000 a year. And for years 9, 10, 11, and 12, because it says inclusive, we're going to be making, oh, I said 50 grand a year. That was overly optimistic, 5,000 a year and 3,000 a year. So that's the money we'll be getting in. And the introduction of the product requires an immediate outlay of 15,000 for equipment, which is estimated to have a salvage value of 2,000 after the 12 years. And we're calculating internal rate of return. And if you look on your BA2 Plus, you'll see that there's the CF button, the NPV button, and the next button over is IRR, which is internal rate of return. So some important numbers we might need. 15,000 is the initial outlay. 2,000 net returns for year 1, 2, and 3. 5,000, 3,000, and the 2,000 is the salvage value. So setting it up here, we got to detail every all 12 years. There's no interest rate here. So we don't start with the interest rate, but we still have outlays and inflows. And so our first outlay is negative 15,000, but these are positive all the way down. And in the very last period, it would have been an inflow of $3,000, but we have to take into account the salvage value. The salvage value adds to the last inflow. And so in this last column, we have all of these numbers that are the result of the outflows and inflows. And the command we're putting in here, the function is IRR bracket. And we just highlight this whole column. And this gives us the internal rate of return. In other words, this project is generating a rate of return of 19.8421%. And we can do this calculation on the BA2 Plus. Let's give it a try and make sure I haven't screwed it up. Let's clear the registers first. So CF, second clear. So we're still doing CF, and CF0 is the 15,000 negative. Enter down. Then CF1 is 2,000. This is a positive amount, so enter down. And the frequency, how often did we do this? For years 1, 2, 3. So the frequency is 3. Enter down. So the next cash flow is 5,000. Enter down because it's positive. And this happens for 5 times. Net returns for years 4, 5, 6, 7, and 8. So this is, the frequency is 5. Enter down. And then 3,000. Enter down. And although we get the 3,000 for 4 years, because of the last period being adjusted, this only happens for 3 times. So 3, enter down. And we got a fourth cash flow is the 5,000, which is the residual value plus the 3,000. Enter down. And this happens once. Enter down. And now we're being asked about cash flow number 5, but we have no cash flow number 5. So we've got to press the button IRR. And it says 0, which is confusing until you realize we have to press compute. Takes a while to think about it. And it comes up with 1984205944. So, did that work for you on your calculator?
Hey, Mr. Brown, could you explain again why the frequency for 3,000 and 5,000 is 3 and 1? I got
Yes.
it for 2,000 and 5,000,
Yes.
but not for the third and fourth.
Let's go back up here to where we started. The 3,000, the net returns are for year 9, 10, 11, and 12. So that would be 4, right? But the last one is adjusted because of the $2,000 in the salvage value, right? This salvage value is $2,000. So in this last period, what we're doing is we're taking the 3,000 plus the 2,000. And so because we had to adjust that, we can see that this 3,000 here only happens 3 times, and the 5,000 happens 1 time. And then when we translate it down here, this has to be the 3,000 and this or 3 times, and then the 5,000 1 time. Does that help?
Okay, thank you.
Yeah, it's tricky because you've always got to make that adjustment. It's easier to see up here where you can see the adjustment, but not down here where you've just got to know that it's 3 and 1 and not 4, and a separate cash flow for the salvage value. They didn't program in a separate function where it asks you about salvage value. It might have been nice if they did. That would have been simpler, but they didn't program it in here. So you've got to do the adjustment yourself. So any other questions about that before we look at the last? Basically, the last thing I will inflict on you before I torture you with the final test. So if I start reading this question and you cannot see the question, let me know right away. The Blue Sky Resort plans to install a new chairlift. Construction is estimated to require an immediate outlay of $220,000. The life of the lift is estimated to be 15 years with a salvage value of $80,000. Cost of clearing and grooming the new area is expected to be $30,000 for each of the first 3 years of operation. Net cash inflows from the lift are expected to be $40,000 for each of the first 5 years and $70,000 for each of the following 10 years. So I've sorted out the numbers we're gonna need. The 220,000 is the initial outlay. The 80,000 is the salvage value that will show up in year 15. 30,000 is the cost for clearing and grooming for years 1, 2, and 3. 40,000 are the net returns for years 1, 2, 3, 4, and 5. And 70,000 of the net returns for years 6 to 15. So we set up this schedule. We have the outlays, the 220,000, and then 30, 30, and 30. And the inflows, 40,000 for 5 years, and then 70,000 for another 9 years. And of course, the last cash flow has to be adjusted because of the salvage value. So over here, we can figure out that the initial investment is 220,000 and the inflow is 40,000. The outlay is 30,000 for the first 3 periods or first 3 years. We're looking at 10,000. Then we get 40,000 for 2 years. Then we get 70,000 for another 9 years. And in the last year, we get 150,000. We calculate the internal rate of return, and it says this whole project is generating 16.865%. We can do this same thing on the BA2 plus. First off, clear the registers. So CF, second clear, then hit CF. So we have a payment of 220,000, so 220,000 negative, enter down. So the first amount of money we have to worry about is 10,000. It's positive, enter down. And we know this is happening 2 or 3 times. So the frequency is 3, enter down. Then we have 40,000. And this is happening twice. So the frequency is twice, enter down. Then we have 70,000. And this is happening for 9 times, enter down. And then we have 150,000, enter down. And this is happening once, enter down. And now we're looking at cash flow 5, which doesn't exist. So we have to press IRR. Takes a little while to think about it. Takes a long time to think about it. Either that or my computer has died. How's your calculator doing? Mine isn't doing anything. Oh, maybe because I haven't pressed compute. Okay, that helps. 16,865,0 0201. So 16.865%. So I don't know if you're anxious to get onto Moodle and try those questions, but Moodle is not available at the moment. They said it would be available at 11 a.m. But often their estimates are early. So hopefully sometime this afternoon, you'll be able to get on Moodle and try some of these questions. and see either how much fun they really are or how terrible they really are. So, any questions you can think of asking before I wish you good luck? I'm trying to make this button that you have to press look more like a button and not something you're going to see. Okay. We won't have class after this. We will have class, but the classes will be optional. So, I've had a few questions here. The chapters for the quiz means midterm. I'm assuming you actually mean final. Final will cover chapters 6, 7, and 8, and compound interest chapters 16, 14, 15, and 16. That's really compound interest assignments, 10, 11, 12, and 13. Someone's asked about the homeworks. I will download the homework assignments after the final test. The test, yes. Someone's asked about the test. You'll still have a 24-hour window. You'll still have the 24-hour window. The window will be from 9 a.m. Let's put that in here. Friday, what's that date? Friday, the 13th, sounds ominous. So you'll still have the same 24-hour window. And so, but anytime within that you start the test, you'll have 3 hours. Am I missing any questions in here? Yeah, what will be discussed during the next classes, it will be just like the regular office hours. If you have questions, we'll have class next week. And we'll have class the week after that for whatever people by that time feel they need to learn or get help with. I mean, how many questions will there be on the final exam? Much like the 3 exams you've already done. 15. Someone tried to say something, but I didn't hear it. Would there be an amortization schedule? No. There'll be 3 amortization questions, but no actual schedule to fill in. Percentage weighting. The final exam is worth 30% of the course. So any other questions anybody can think of asking at this time? Okay, in that case, I wish you good luck. You can't get onto Moodle yet, so. Yes, the last few chapters are confusing. They're probably the most useful information in the whole book, but they're definitely the most difficult. I personally found chapter 15 very confusing. I don't know whether it was me or the textbook, but all that stuff to do with bonds is not easy. So I've enjoyed having you as students. Hopefully before your program is finished, we'll all have survived COVID, and we might get a chance to actually meet face to face.
Thank you, Mr. Brown.
Okay,
Thank you, Mr. Brown.
especially if you get to come to Canada. Not much chance on meeting face to face if you're still in India, although I very much want to go to India. Visiting the Golden Temple is on my bucket list. Okay. So take care, have a good day, and we'll see you next week if you need help. Or send me emails anytime you have problems with anything to do with the questions you're dealing with.
See you.
See you.